Hey guys, it's Crypto Llama here, and I continue to get asked questions about liquidity pools and folks wondering which would be the best to invest their capital in. For this reason, I thought I'd do a quick no-fuss analysis on liquidity pools, how they work, the risks involved, and also the pools which I think would be the best to invest in. Please note that any information within this video should not be considered financial advice. All opinions are that of my own, and if you intend on investing your own capital, you should always seek professional advice or do your own research. With that being said, liquidity refers to the ease of which an asset can be sold quickly for another. It is essential to DeFi or decentralized finance ecosystems, given that there are no centralized authorities providing the liquidity for users, such as Binance, Coinbase, or other popular exchanges. The problem lies in the fact that a centralized exchange will always tend to situate the advantage within their favor when exchanging tokens, because they have a monopoly on the exchange of these tokens because you're interacting with their order book. They make their money on the spread in between the purchase and selling rates of those tokens. And it's a catch-22 because without these centralized authorities or market makers, the exchange market loses its liquidity and becomes inconvenient for the average users due to higher spreads and the longer duration taken to swap tokens. Enter liquidity pools. The idea behind liquidity pools is pretty simple, and yet there are many who find it difficult to grasp. These pools allow us to forego the order books of the market makers and centralized services by redistributing all the fees and trading activity income among the pool participants and the liquidity providers. With Tribal Dex or Hive Engine, for instance, there is a fixed transaction fee of 0.25%. We can see that here, but in a nutshell, liquidity providers get to earn a portion of the pool's trading fees according to what share of the pool they own as a reward for their services. Over time, liquidity providers can earn substantial amounts annually through trading in liquidity pools if the conditions are favorable. You'll also see that some liquidity providers switch between numerous liquidity pools to boost their earnings based on APRs, which is known as yield farming. Although these APRs may look extremely enticing, there are some associated risks which you'll need to consider before becoming a liquidity provider. The most important being impermanent loss. Impermanent loss refers to the temporary loss of liquidity pool tokens. This happens due to a number of factors, but mostly in the form of price volatility. For instance, in the case of the SPS and DEC liquidity pool, if the price of SPS drops by 20%, then liquidity providers will get less value back. This is because they've lost 20% of their initial deposited amount into that pool. Therefore, these tokens are no longer equal to their initial value when deposited into this pool, resulting in a transient loss. In volatile or bear markets, liquidity pools can be fraught with danger for novice investors because frequently these type of swings can result in impermanent loss. Moreover, based on the size of these price swings and the duration which a liquidity provider stakes their deposit, the impermanent loss might be offset partially or fully with these rewards. But if you are a liquidity provider and you choose to withdraw your deposited funds before this happens, you will need to be aware that your loss has now become permanent. When choosing the right liquidity pool for your investment, it's similarly important to recognize that token pairs with higher liquidity have higher trading volume and lower volatility, whereas those with less liquidity have higher volatility. Understanding this concept will ultimately lower the risk entailed in your investment. Of course, there is the flip side to this in that pools with larger reserves are less profitable from fees, as there is plenty of liquidity to fill the larger orders. So you'll need to decide which approach is suited depending on your appetite for risk. The ideal scenario for liquidity pool holders is sideways trading with no large swings to the downside or the upside. This will allow you to earn your portion of rewards while still maintaining your original deposited position. It is for this reason that correlation analysis is vital in finding pairs which share similar price attributes. Here we can look at the similarities in price action between some of the larger pools. When we can see the mountain chart dipping below, this is when the pairs are experiencing temporary decoupling. Through this analysis, we can determine which pool has the closest correlation. Looking at these main pools, we can see that SPS and BNB share the closest price action and therefore would be the least risk adverse. We can also observe that this pool has the most capital deposited, which again lowers our risk involved due to the high liquidity and higher volume. It's important to do this type of analysis frequently as token pairs can decouple quite regularly. For this reason, I would suggest that if you do not have the market knowledge, it's probably best to stick to regular staking rewards and leave the liquidity pools to the whales. And that's it for me for now, guys. If you enjoyed my video, please hit that like and subscribe button so you can stay up to date with all my updates. But other than that, I will see you on the blockchain.